As you might guess, I'm very pleased to launch with a neighbor and great friend of our program, Andy Hogshead. Many of you already know Andy, and several of you got a chance to visit with him, get better acquainted with this delightful guy just a few minutes ago. Who is he? Well, he's Chief Operating Officer of the Collier Companies, so he's the person that Nathan Collier has given the power to oversee his companies. He joined the Collier organization in 2004 as the Director of Acquisitions, and now he is responsible for sort of keeping the company's growth and financial structure. And he was telling us just a moment ago that that's been a broadening experience as the companies grow and reach out into more and more concerns. But prior to this, his involvement with the Collier Companies, he had 17 years of experience in real estate finance, most recently as the Senior Vice President of Wachovia Bank's Real Estate Finance Group, one of the major finance groups in real estate in the country at that time. He earlier worked with a number of Wall Street investment banking type firms before he went with Wachovia. He's a Harvard undergraduate, got an MBA in real estate and finance from Columbia University in New York, and currently is involved not only with the Collier Companies, but with a number of different local and regional charities, and an interesting position that I think is he's currently on the Florida Department of Education's Advisory Board, Advisory Council for Education Facilities, a major challenge here in Florida. He's also a member of a group that some of you know of, the National Multifamily Housing Council. We know him primarily as a great friend and the most thoughtful person in real estate, and so we're pleased to have him serve as a ring speaker today. Andy.
Thank you. It's great to be here. I talked a little bit with Wayne and David about what we should talk about. A lot of times people talk about their companies and sort of what they're doing. And you guys, if you don't know about the Collier Companies, you definitely will get an inside look at it during your time here. Nathan usually teaches a course and often teaches a couple of case studies. You'll get to see a couple of real life things as they're happening, and sort of get to see the murky realities of deals as they unwind and come apart and then go back together, et cetera, et cetera. Today's kind of a special day. Actually, I want to point out that we do have some Collier Companies team members here, including, I want to especially recognize Aaron Harden. Aaron is with us. He is a graduate of the Warrington School, and he has just closed his first deal today. I think, did the wire go through? There you go. So he just bought 2 properties, one in Tallahassee and one in Athens. So quite an interesting and exciting trip. You guys are all, if I tried to put myself in your place, if we're not going to talk about the Collier Companies, what could I come here and talk to you guys about that you'd find interesting and stimulating and hopefully take something away from? And I thought back to when I was in business school, and war stories are kind of cool, but they're hard to apply to, how does it affect you? And so I really thought about kind of my experiences with real estate, and I kind of thought about, you guys are sitting here on the edge of careers in business or real estate, because real estate touches so many aspects of business that a quote-unquote career in real estate can consist of many, many different things. I've had 4 or 5 careers in real estate doing different things. I've been at the Collier Companies and literally had 3 different jobs. I'm sort of growing into my current job, which is not at all like my job as Director of Acquisitions there. So I thought, if I could bring some points out about a career and sort of highlight some of the experiences in my life and how the markets shaped what I did for a living and how the markets shaped the industry, I thought there might be some benefit to that. So without further ado, I wanted to go ahead and talk about this. A couple of highlights to take away from this. Real estate is both a capital markets product, but it's also a good that people consume. It's tightly linked to both. Demographic trends drive real estate. Capital flows drive real estate. Development trends, legislation, all of those have huge impacts on the market. What your customers want is ultimately going to determine whether you build something that's successful or gets knocked down without ever having been occupied. My particular experience is mostly on the capital side, so I just want you to recognize that there are a variety of experiences that are available. Mine is going to be primarily capital driven. I wanted to show you this. We'll start out with a good capital graph. This is the 10-year yield, the yield on the 10-year Treasury from 1972 to 2012. What this says generically to me is the risk required to hold a Treasury has gone down consistently. The graph bounces around a good bit, but the trend of the last 25 years has clearly been down. What that means is if you deal in cash flowing assets, assets whose value is measured by sort of compiling the future cash flows, this is a great time to be gathering those. They are growing in value just simply by holding them. Even if you're not increasing their cash flow, by and large, a cash flowing asset here in 1982 is not worth nearly as much as it is in 2007. 1982, you could buy all the government bonds you wanted that yielded 15 or 16%. Now a 10-year bond barely yields 2%. And the government is telling the world that they're going to keep it that way at least through 2014. So capital flows have made a career in real estate a really good thing over the last 25 years. The other thing to think about, I mean, this is obviously this chart goes back before I was in the business. It probably spans a working person's career in real estate. Time frames are very long. If you want to get into development, a development project is 5 years. I mean, just plan on starting, looking, finding, getting the zoning, lining up the financing. If you're doing something that requires tenants, finding the tenants, getting it built, getting it leased, getting it financed, and getting it done, it's 5 years. So in real estate, you have to start thinking in longer terms, and I would encourage you to plan your careers in longer terms too. We have a phrase in the Collier Company that's called 3 steps into the fog, meaning that we don't know what's going to happen, you don't know what's going to happen, you have to sort of have a general direction, and you take a step and things become a little clearer, like on walking into a foggy day, and you take another step and you take another step, and you find hopefully that you have reached your objective or your location and you haven't walked off a cliff. But I would encourage you to think in longer term time frames. I'll point out a couple of decisions I made that were short-term time frames and point out that perhaps I was not as happy with them as I thought. As I said, your working life is probably going to be 30 to 45 years. I'm planning on working till I'm at least 65. This is fascinating work. I mean, it's hard. You're going to be stressed out certain days. Things aren't going to go right, but I really can't imagine anything else that's as fun or challenging. I mean, you can play all the Modern Warfare 3 or Fallout or whatever you want. It just doesn't have the same sort of get you going passion. And if you do something right, and you really love what you do, you will not be rewarded like you will in a successful career. So let's talk a little bit about, you've seen this graph. Let's talk a little bit about some of the things that happened in real estate and some of the things I was doing at the same time. 1980, I hadn't graduated college yet. I was an anthropology major, and I was tooling around, but even I knew something major was happening. I knew people were getting all fired up because credit card debt was above 20%. I knew that, you know, people were taking out student loans as fast as they could because they were fixed by government standards at 10%, and they were putting them in the bank, and they were making a positive spread of almost 10%. So this was a huge, huge deal. This was transformative to the U.S. economy. A gentleman named Paul Volcker stopped inflation in its tracks by just crushing the money supply and wrung inflation out of the, out of the economy. He did it at the cost of probably the worst recession before this one since the Great Depression. So totally reshaped the American landscape and set, for all financial assets, set that long-term slide in interest rates in motion. Probably the most significant effect on real estate in the last generation was the Tax Reform Act of 1986. And this is worthy of note. It's not dusty prehistory for you guys. As Congress wrestles with budget deficits, mark my words, they are going to increase taxes one way or the other. It will be done. And just because they raise the rates, they raise the incentive for people to find shelters and ways around it. Real assets that can be depreciated are one of the key ways of doing that. So my bet is you're going to see a lot of real estate values popping up in tax shelters and things like that. Right now it's oil and gas and all kinds of other things. But this is significant. I'll probably be coming back to it. 1987, there was a Wall Street meltdown. It was worse than the one in 2008 in its severity. Dow dropped 25% in a day, and it recovered much faster. The underlying economy was not as weak and not as collapsed. My personal history here is about where I start. I went to go get an MBA in 1986. Be interesting to know how many of you guys were born by 1986, but I went to go get it. I thought inflation was going to be a big deal. Oop, what was that? It's on here. Okay. I went to go do something because I thought, 1988, I graduated. I went to Columbia, which churns out zillions of investment bankers. People used to walk the hall wearing braces with slick back hair, and they all wanted to be, sorry about that. They all wanted to be investment bankers and, look like Gordon Gekko on Wall Street, et cetera, et cetera. I do remember in 1987, we had these new cutting edge things called Bloomberg terminals, and they were monotone green screens, but they were real time, and they were really neat, and people used to crowd around them and watch. And most of the people, by 1987, most of my class had jobs, and most of them were going to go into sales and trading. And I vividly remember somebody watching and running out and getting sick outside because they were just watching Wall Street collapse right there, and they knew their job offers were rescinded. So very, very, very exciting times, but somewhat stressful times. I was a real estate banker, so I felt sorry for those guys, but I knew inflation was coming, and I got a job with an investment bank, which is long gone, called Kidder Peabody, and I was going to go and be with the real estate group, which was doing a lot of deals based on mergers and acquisitions activity. You know, that was cool. I really was going to be Gordon Gekko, and I did have suspenders. Never went the moose route, but I did have suspenders. 1989, mergers and acquisitions killed by that Wall Street collapse. M&A was dead. I got an opportunity to work in the firm marketing investments to the Japanese. Didn't know it at the time, soft dollar bubble, a soft dollar, which was caused by the Fed's easing, led to foreign buying binge of assets. The Japanese stock market tripled in like a year and a half. They were buying American real estate left, right, and center, and I was a big, tall guy with a loud voice and a big nose. As one of their guys told me, it's like, okay, you're perfect to go sell this stuff. Get on a plane, go sell it. So I did. Unfortunately, that party came to an end. The Japanese asset bubble burst, and I had to find a new thing within Kidder Peabody. Fortunately, American real estate was sliding right alongside with it. The Tax Act, we didn't really talk about that much. Do you guys cover that much? Okay. Used to be, back in the day, you could take a property and you could depreciate it, and normally you can take it and you can depreciate it over 27 and a half years. You used to be able to depreciate it faster than that, which meant you could write off on your taxes. And there were allowances for individuals to own investments in various hard assets, real estate being a big one, and deduct it off your taxes. And you could get these very large write-offs for your taxes, and you would not owe taxes. You could offset income earned over here with these losses earned over here. And so the value of these losses was approximately equal to the tax rate you paid. If you could write off $1 and your tax bracket was 70%, you could save 70 cents. So how much would you pay for that shelter? You'd pay up to 70 cents. And there was a massive industry that really pumped up real estate prices in the mid-'80s because of that. All that got taken away with the Tax Reform Act of 1986, which was, on balance, was a very good thing, even though it destroyed the real estate market. But it created probably there was the vehicle through which this happened was a syndication, and this is how people, doctors, lawyers, entrepreneurs that had excess cash would buy these syndications, and they were never intended to make money. They were intended to throw off investment losses for your taxes and all that. When that whole game stopped, the money dried up, and a lot of real estate classes totally cratered. Condos in Florida, there were walls of unsold condos, shockingly like 2008, 2009. Part of why we were talking about being optimistic about real estate coming back. It's happened before. It'll happen again. So in 1989, you can get a hell of a deal on an oceanfront condo. So this rippled through, this problem, this lack of liquidity, this loss in investors sort of took a while to work its way through. Part of what happened, and it's part of a larger issue, but it affected savings and loans. And the savings and loan industry, which was dependent on this equity capital that it could make loans to and then get permanent loans, ended up sort of making a bunch of desperate loans trying to keep their heads above water, and it didn't work. So they had a bank failure. It wasn't really bank failures, there were little banks, but mostly it was the savings and loans industry, which had been deregulated. And they went down. They were solved by something called, wrong one. All right. it was solved by something called the Resolution Trust Corporation. The Resolution Trust Corporation took over all these assets, and these assets were loans. I mean, many more loans than actual real estate properties. And the real estate properties were held, but what they really had was boxes and boxes and boxes of files. And these represented loans. They're like all of the toxic CMBS you guys are learning about now. They just happen to be aggregated in one very convenient spot. And the RTC set about trying to create a market to restart the real estate capital cycle. And they actually did a really good job. Several of my bosses at the time walked in one January morning, coincidentally after our bonus checks had cleared, and said, "What are you doing? Why don't we go start something else?" Being young and greedy, I did. I went to work with some guys. We set up a firm and we bought large blocks of assets from the Resolution Trust Corporation. And very exciting time, very fun. People said, "What do you do?" I said, "I buy warehouses full of files." And we'd buy them, and it was kind of like Christmas. You'd go in and you'd read a file. And sometimes the files were really good. You know, it had all the pieces of a loan. Sometimes the files were missing little details like a mortgage or a note or a guarantor or a borrower or anything. And, you know, that's kind of like, oh, see that one. But overall, if you bought, one of the deals that we bought was $440 million of face value. And we bought it for about 138. So we had some room to play with. Oop. Yep, okay. All right, the RTC only did that for a little while. They were pretty smart and realized they were going to lose a whole heck of a lot of money in a hurry fast if they did not do something else other than sell assets which had a face value of $1 for 40 cents. They ended up trying a bunch of strategies. They restarted REITs. They restarted the commercial mortgage-backed securities market. People had some interesting ideas about it, but nobody had really done it on a big scale. The RTC got started with all of that. And that was, you know, overall, the RTC was a huge success. And coincidentally, a lot of my friends who made money in the RTC thought, hey, this is great. We got another downturn. We're going to do this. And they went out and they raised a bunch of money to go basically replay the RTC game. The trouble is they raised it in about 2008, 2009, and they're still waiting for something to happen. Unlike then, we're just kind of kicking the can down the road. So then and now. I guess you would say, why are we kicking the can down the road? My only guess to that is that the problem is so much bigger now and the economy is so much weaker that you can't grab the bull by the horns and write everything down to the extent it needs to be written down. All right. So this mess begins to work itself out. By 1993, the United States is pulling out of the recession of 1990. It's starting to grow again. It actually was growing for a while, but it's growing slowly. It starts to grow better. The Fed responds. The Fed pumped liquidity into the market. The Fed was pulling it back by this point, and they raised interest rates fairly dramatically. They used to only mess with the short end of the curve. They raised it 300 basis points one spring. How do I know that? Well, I remember it quite clearly because we had made a fair amount of money buying and reselling and resolving these loans, and we told ourselves we'd all stay together and not take money out of the business, and we would reinvest in things. And we sort of looked for different businesses to invest in. We bought a municipal broker-dealer for securities. We started getting into this whole cool securitization thing and buying mortgages that we could then re-securitize, and so we were aggregating this. And Basically, these businesses require a lot of capital. And the businesses that require a lot of capital, we were borrowing overnight. Basically, we were buying on an overnight price thing, and we were buying assets that were priced, 5, 10-year duration fixed assets. And we did not see the rise in short rates that came because it came so fast and it came so hard, we couldn't unload it, and basically the value of the assets that we held was not worth the value of the margin of our debt. And that was a dramatic challenge. All I could do was take comfort in the fact that I wasn't alone. There were several other ramifications of this rapid rise in short interest rates. The dollar shot up, which knocked the relationships between currencies off kilter. And Procter & Gamble, I think, was trying to speculate a little bit on their foreign currency exchange. It was a new game back then. And they got caught doing that. Orange County, California tried to do an exotic sort of, back then, early day bond derivative with municipal bonds, and basically they got caught in the same squeeze and they got bankrupted and Merrill Lynch got fined, and it was an ugly time all around. What did we do at the time? Basically, while we were working this thing out, we entered into advisory businesses. I ran two things. We advised the FDIC on some securitizations, and also I spent a lot of time doing a workout at Mutual Benefit Life, which was actually to stand me in very good stead here because Mutual Benefit Life had a portfolio of 44 multifamily housing deals that they had built in conjunction with Trammell Crow and Metric Partners and some other people, and we had to work those out. So that was a good training ground for coming to the Collier Companies later. In 1994, we got the opportunity to enter into a special servicing business, which we did, which back in the day was very lucrative. It's kind of dried up, but it was an interesting, another skill set. None of these things seem related, but they were just opportunities at the time taken. All right, by 1995, real estate was starting to recover. Sam Zell, who you guys may or may not know, but has kind of always been, a god in the real estate industry as I've known it, he was famous in 1989 for saying, "Survive till 95." And at the time, nobody could believe that it would take that long for the real estate market to recover. But he was right. Survive till 95 was a good call. By this time, we had worked out the partnership deal. The business was solvent and stable again. It had morphed from being a transactional business, buying and selling assets, to being an advisory and a financial services business. The special servicing was there. They were experimenting with things like tax notes, and that's actually where they've gone with the business and other stuff. And it really wasn't for me. In addition, I had 2 young kids. I was living in Manhattan. I really didn't know if I wanted them to grow up to be little Manhattanites. And Jacksonville, Florida, which is where I had grown up and had sworn that I would never go back to, suddenly started to look pretty appealing. My mom and dad were there. My ex-wife's mom and dad were there. We had babysitting. Life was good. So I moved to Florida, and I joined an aggressive bank at the time called First Union. That one's not relevant yet. Joined First Union. There's a slide a little bit later. Basically, banks set in motion from that extreme run-up in short rates was the fact that banks started consolidating. They needed size and scale. Bank deregulation and the 1990s crisis kind of brought interstate banking into the market in a big way, and there were big cost advantages, and banks were entering all kinds of lines of business, and they were not a stodgy, staid industry. They were very dynamic, and I have it in the wrong place, but you'll see a phrase here, capital market supermarket was what they wanted to be. They wanted to sell you everything. They wanted to sell loans. They wanted to sell derivatives. They wanted to sell capital markets advice, private banking advice. They wanted to get into insurance and all kinds of other things. And they did. And I was an investment banker in search of a good job in Jacksonville, and that happened to be it. So it was a really interesting and exciting job. It was not sort of what I thought it would be. It was even better. It was cool. Real estate was doing well. This is a bank that wanted to do deals. They were doing deals. They had all kinds of new products. Customer base was getting to the size they could use these products. So this was it was a very, very fun and successful merger. There were some bumps along the way. In 1997, there was a Russian debt crisis and a failure of one of the early hedge funds called long-term capital management. That caused turmoil in the capital markets side of the business. It had almost no effect now that people remember, or at least I don't know of any. But at the time it was big news. 1999, internet ran up. Bernanke gave him, I'm sorry, not Bernanke, Greenspan, who was the chairman of the Fed before, two Fed chairmen before Bernanke, gave a speech about irrational exuberance of markets, and it's not the Fed's job to burst bubbles. He gave that speech in like 1999. That was a full almost 3 years before the bubble actually burst, and we were, it was really funny because real estate, which had been so cool, was really just, totally not sexy next to an internet stock, which really had no fundamentals whatsoever other than the fact that it was an internet stock and really cool. So you have to always look at these things. You also have to look at them. I was a big proponent at First Union for a thing called telecom hotels, because we all knew that the internet was going to take over the universe, and that they would have these giant buildings that would be located near fiber networks to do this. And so I was trying to get First Union to finance a whole series of these things. And it was a good idea. The companies, before we were able to do it, the companies went bankrupt, but the idea was good, and actually the people that made the most money were the railroads, because they had the real estate networks to run the fiber banks over these long distances. Oil and gas pipeline people were running fiber networks alongside and making a lot more money off their fiber network rights than they were off their oil and gas at the time. The railroad people were making a lot more money off their internet cable than they were making off of their railroad. It was interesting idea, but they manifest themselves in different ways. Okay. Also at the time, you see the internet bubble bursting. Alan Greenspan responded by easing liquidity. 2011, we know what happened. Greenspan really eased liquidity on the heels of that. I mean, literally, this is a history of the last 20 years, the history of using things to keep the economy going that had never been done before. And we have seen that amplified in spades over the last 2 or 3 years. The note I would say is, if you look here, you'll see a lot of back and forth in the economy. This happened and it was good, but this happened and it was bad. So think about that when you think about the volatility of the next couple of years. As Fed loose money policy and liquidity leading with low short rates, there was aggressive speculation in long-term assets like real estate and debt in general. All right. 2004, First Union, as I had said, was a go-go, aggressive, dynamic place. As that banking franchise filled itself out, they merged with another bank called Wachovia and became stodgy and staid and institutional again. And that was, you know, perfectly fine, except I wanted something different and wanted more of a challenge. There was this hotshot real estate developer in Gainesville. Actually, I had a lot of fun because I was the Wachovia calling officer for North and Central Florida, and I had a pretty neat customer base. They ranged from guys like Nathan to guys like Regency Realty that were here recently, and it was kind of fun to kind of see the waterfront. But I was really eager for something that was exciting and dynamic and would let me kind of make a mark. And frankly, Nathan's firm was very small by my customer base standards, but they had one of the best operating platforms in North Florida and really looked like something that we could do something with. So they wanted to grow. I wanted to help them grow. I came on as their director of acquisitions. This is a problem because I'm doing this when all that liquidity is pumping into the market. There's a whole lot of real estate speculation going on and cap rates are dropping. There was a concurrent event, debt, because driven by new forms of capital like the CMBS market, were pumping cheap debt in, but Nathan's yield requirement, his equity requirement remained constant. So we had trouble squeezing. At some point, you guys will probably work through a couple of examples with him. How do you squeeze, if you have a capital return requirement of 20% and you're buying an asset at a 6% cap, you have to gun the cash flows on that asset big time in order to be able to get 20% out of that investment. You have to borrow a whole lot of money at a whole lot of discount so that you can leverage it up and get that. And that became harder and harder to do, even though the capital markets were sort of obliging with more and more cheap debt. Our answer to that was institutional partners. We started to take on institutional partners. We did our first deal in 2005. We kept buying deals with just Collier Companies capital, but the way to take down deals and grow strategically was capital. Okay, I mentioned this. I guess I should have put that in a different place. Again, residential real estate was the recipient of all this excess liquidity. 2005, height of the residential boom. I don't know how many of you guys were involved in real estate, but it was a wacky time back then because, again, the fundamentals had totally separated themselves from valuation metrics and what people were paying. They were buying multifamily properties to turn them around, cut them up into condos, and flip them as fast as they could. Made buying a challenge. All right, in 2007, simultaneously, I think some of the private equity guys began to see the handwriting on the wall, started to pull back. At the same time, the conduit lenders are partying like it's 1999. They are doing absolutely insane deals. We are pinching ourselves while we're doing these deals. You know, can you believe? Even I wouldn't lend me that much money, and I trust me. So we were acquiring properties with both. Okay, this probably culminated the crescendo. We refinanced 7 properties. We were anticipating inflation. Again, you sort of see that thread running through my whole mantra here. Better lucky than smart. We refinanced just as they were taking the punch bowl away. We got insane terms. We got loads of money. It was great stuff. And then the party stopped. Liquidity completely dries up, except in certain government sectors. Fannie Mae and Freddie Mac have continued to lend, which is why the real estate sector, multifamily specifically, residential's cratered for different reasons and isn't coming back, even though Freddie and Fannie is standing there with the cheapest mortgage rates pretty much ever, and the Fed and the Treasury are doing absolutely everything they can to keep interest rates down. Residential is fallen and it can't get up. Unfortunately, there is not a similar source of liquidity for many other real estate asset classes. It's sort of coming, CMBS is sort of coming back. It'll probably be back in a year or two, but liquidity dried up, and has pretty much, except if you're in multifamily, has stayed dried up. Our sort of the war, couple of war stories that I could tell you about that I look back on and shake my head on. We bought a deal in 2008 with J.P. Morgan. This is a multi-step dance. In between, at one point, you commit money. You say to the seller, we will let you have this money, and we will close. This was a long and contentious process because the sellers didn't want to sell, and the two sellers were arguing with each other, and so there was fractiousness over there. We had some things to work out with J.P. Morgan. J.P. Morgan had some questions about the asset. J.P. Morgan was the portfolio manager was getting raked over the coals. What the hell are you buying anything for? Why are you spending money? And it was there. We could see the goal line. We were getting ready to close. We had gone hard on our rate deposit, which was like $500,000, and our lender suddenly got very quiet. Fannie Mae went into receivership while we had wired them money. We had rate locked with them. So we now have a couple of $1 million out because this is a $48 million deal. And Fannie Mae went into conservatorship. Never happened before. Nobody knew what to do. I will say, if anybody ever asks me my opinion of C.B. Richard Ellis, they are totally stand-up guys, because the way this works is C.B. Richard Ellis makes the loan, gives us the money, gets the documents back, and then sells them to Fannie Mae later, okay? They didn't know if they had a buyer on the other side. So they gave us $32 million. And they were not 100% sure they had a buyer on the other side, that Fannie Mae would buy the paper off them, could buy the paper off them. And they agreed to a spread, a rate. By today's standards, it isn't so good. It's 6.25%. But if you'd had a real Depression-style meltdown, that paper might be 10, 12, 14%. But they went ahead and did it. The Fed reaffirmed that they would honor Fannie and Freddie's obligations like a day or two later, and that we went ahead and closed as usual. But that's like whatever can go wrong will go wrong. I had that slide a little bit later about how it's better to be lucky than good, lucky than smart. Sometimes the best thing that you can do is unanswered prayers. We had been looking for a loan for a property, and we pushed this loan through, and we got it done with Wells Fargo back in November of 2008. And it was probably the last construction loan done in Florida. It was certainly the last construction loan that Wells did in Florida. But we went ahead and built the property. Unfortunately, we have struggled to get the asset built up and stabilized. We're on our way to doing it now, but again, if I had just not been able to do that, it probably would have saved me a lot of headache down the road. 2008, business challenges, downturn everywhere. Gainesville was the recipient of some heavy attention in the student housing space. We had an especially severe downturn here because there was a ton of supply, coupled with the fact that the university announced enrollment cuts, so supply-demand crunch. And I don't have any stats to prove this or anything, but I think that a lot of people who were in Gainesville kind of hanging out, maybe going to get a professional degree, maybe in between classes, things like that. Their parents just said, come home. Because the occupancy drop and the rental rate drop just cannot be explained by something else other than a big chunk of demand left that I don't know where it went. That's my guess. We also had bought some insurance, some derivatives to basically offset the risk of certain construction loans that we had built, and then we were going to roll to permanent financing. Just like back in 1993, the market went way the wrong way on us, and we have significant exposure, which we have cash collateralized. Again, I always like to take a little comfort knowing that I was wrong in good company. The Harvard Endowment did the same thing, building a center for something, and they settled their derivatives for $1 billion. It was like 5 or 6% of the entire Harvard Endowment. All right. Other significant things that have happened. We have seen some of this. General Growth was a REIT. The CMBS markets were built upon being able to get quick and easy access to the real estate as collateral. It was supposed to be transparent. At one time, the CMBS lenders said that we are going to have one set of documents that everyone will sign, and this will be uniform. And it turned out not to be that way, but they always rested their laurels on the fact that we have this corporate structure that'll let you get to the asset quickly and easily, and you can't use bankruptcy as a defense, et cetera, et cetera. A company called General Growth, which was a REIT, owned a whole bunch of B and C malls across country, had a liquidity squeeze because their treasurer was smoking dope or something, and had a whole bunch of loans maturing all at the same time. And that same time happened to be like 2009. And there was no liquidity anywhere. And so he couldn't refi. They elected to go into chapter. And the judge listened to it. And honestly, there was a good reason why the judge should listen to it. And the judge sort of upheld the bankruptcy, which has caused shockwaves through the securitized debt industry since. I mean, out of a stack of paper that thick to do a securitized loan, probably that much of it's new. Protections they have sought since then. So it's just interesting how things happen, maybe for the right reasons, but they have effects everywhere else. We were able to get liquidity. The good news, as I said, Freddie Mac was there for us. We were able to do loans even in a bad market like Gainesville, 2009. 2010, we had a major recapitalization last year, pulled it off. It was interesting. I was telling these guys that looking back at the old pro formas, our cash flows were about 20% low, but that's okay because our cap rates were also about 20% lower, so we netted out approximately the same values. We are seeing a good recovery in Gainesville. We saw good recovery in 2010, good recovery in 2011. We're anticipating a good recovery in 2012. We will still probably not catch up to where we were in 2007, which is the year the lights really went out, until probably 2013. I'm going to guess 2013, maybe 2014. All right, this again, in closing, this is the historical 10-year. It looks like a pretty smooth ride. Again, you don't see the trauma there, but if you look, that's the long end of the real estate curve. If you look at the short end of the real estate curve, this is the 30-day LIBOR. You can see the Fed tightening. You can see the Fed easing. You can see the Fed trying to engineer a soft landing at the real estate crisis. You can see the S&L crisis. You can see the recession. You can see it building back up. You can see the Russian debt crisis. You can see the internet boom. You can see 9/11. You can come through here, you can see Alan Greenspan trying to get George Bush reelected. You can see a late reaction here. This is where the housing bubble happened, right there. You can see the crash. You can see the Fed doing things it has never done before. And now they're even bragging to people out on the street. They're not only doing nasty things, they're just telling people they're going to do it beforehand. So this is a much better picture of the volatility that I've seen in my career than that. But this is still the underlying reason why you do it. Values historically have gone up. This creates opportunity. If you're not vested in a position, this can create a lot of opportunity for you. All right, sort of past and present. Let's talk about what do the next 5 to 7 years hold. I'm going to guess. These are obviously nothing but guesses. Real estate's ultimately tied to consumer and corporate wealth. It's not easy to outsource offshore. So real estate ain't going away. It is a domestic business. It is dependent on capital. I think it'll always, there will always be great opportunities in the business. It's dependent upon consumer wealth and corporate wealth as to exactly where the opportunities lie. So if I'm thinking about where I'm going, I mean, I'm now with a large company, so my options, your options, you guys have blank sheets of paper by and large. My options are fairly limited because I have chosen to focus in one particular area. But if I were thinking about where a career might be, I would be thinking about where will consumer wealth and corporate wealth be created in the next 20 to 30 years, and how would that drive the demand for real estate? Again, think about it and think about the fact that you're going to have probably 4 or 5 or 6 careers in real estate. I've been an investment banker, I've been a commercial banker, I've been a director of acquisitions, now I'm more of an operations kind of person, but you will do a lot of different things and you will keep bringing the real estate skills to the party over and over again. Well, as I said, inflation hasn't been an issue for the last 20 years, so it's just about time. I'm pretty sure the Fed is going to screw up. They are doing so many crazy things right now that they are going to screw this up. When the economy starts to pick up or something happens, it'll be conveniently right around an election time. And you saw Paul Volcker had to jack short rates up to about 20% to cool off the economy last time. They're going to have to do something like that. They're going to have to pull trillions of dollars out of the economy like that. And they're going to have to slow the velocity of money like that. And if they don't do it, you're going to get inflation. There are people that have said right now that we are pursuing our low money policy, and all we've really done is exported our inflation to China. And that may be true and it may not, I don't know. I'm not a macroeconomist. But I have the feeling that it will take so much discipline and will to deleverage the economy, deleverage the Fed's balance sheet, that I don't think they're going to do it right. So at some point, I'm guessing there's going to be inflation. And again, I'm saying 5 to 7 years. Where's the value proposition? It is looking, as I said, not only corporate and consumer wealth, but demographic trends. I think housing is going to rebound in the next 5 to 7 years as the leading edge of Gen Y decides that, I mean, housing is more affordable than it's ever been. It's going to continue to be more affordable than it's ever been. My guess is that as people start having children, having families, they are going to start looking at the convenience of larger spaces. They are probably going to make the value decision to buy this lower relative priced good. I'm not a big fan of healthcare related spending. You know, the machinery is already in place. You know, you can argue about the wisdom of what we'll call Obamacare. I believe that there will be some form of rationing. I believe there has to be. it's not going to be carte blanche like it has for the last 20 years. Those caps on spending are going to limit what you can do. Maybe there's sort of a value add alternative for healthcare and healthcare spending. We talked a little bit earlier about senior housing, stuff like that. There may be some senior programs like that which may make senior housing affordable. There were big programs in the 70s to try to house the baby boom generation. If you guys have heard of 80-20 housing bonds and all the low-income programs that they had back then, they may have something similar to that. I don't know, but I do not think that spending on healthcare can continue to grow the way it did, and therefore the spending on real estate related to healthcare can't continue to grow the way it has. All right, technology changes, obvious. I don't know. If I were you guys, I mean, I'm just guessing, but I would say office space is the bane of cost cutters everywhere. They're going to continue to drive down the amount of cost per the amount of square foot allocated to each employee. People are going to work from home. They're going to outsource. They're going to not have these temples anymore, except in a few CBD locations where, you need to have this big, really impressive edifice somewhere. My guess is if I were looking for something, unless you had a special use that you thought would be really good, I'm not so sure I'd be working hard on office space. General flex space might be an exception to that. Now, talked earlier about the Tax Reform Act of '86. I think it's a good idea to keep a lot of attention on this, because in 2013, after everybody gets reelected, they're going to announce this grand deal. I'm sure they will, because they won't be up for, at least the president won't be up for re-election for 4 years. And many members of Congress won't either, or excuse me, of the Senate won't either. But as soon as they start raising rates, they, as I said, increase the attraction of tax shelters. And one of the oldest and most venerable of those is the depreciation deduction. And there'll be some other things. There'll be, the American Jobs Act of 2014 that gives you accelerated depreciation when they tried to get development in the area ravaged by Katrina. They allowed you to depreciate an entire project, I think in what, 2 years? Something like that. They allowed super accelerated depreciation, which would basically make your project a success whether or not it was economically viable or not. I was always surprised it wasn't more effective. It's just a testament to, if you lower the tax rates, people base less and less of their decision making on the power of the tax incentive. So I'm not saying whether it's not at all hooked to the fairness argument about who should pay more or what, whether capital should get taxed at a different rate than income. It is just a statement of, the bigger the deduction in a high tax environment, the more someone's going to pay for it. So I would say keep an eye on that. Okay. And any questions? There you go. Well, it was, and it was pretty funny. David mentioned that, when you look at it and you lay it out, there's a lot more things going wrong than things going right, or it seemed like it. And it's true, although generally speaking, you're kind of stumbling up the stairs because asset values are going up.
Nobody here wants a simple, stable path in life anyway, do they?
Well, for you guys, that's where the opportunity is. That's the, somebody said to me in 1990 when I was going to leave the investment bank, which was a pretty cozy job. You could find things to do and it was well paid, to go and buy bonds. Somebody said, don't you want to get in here now when the tallest thing on the landscape is the soles of the dead giant's feet? And I was kind of like, yeah, that's cool. I want to go do that. And there's turmoil, and if you're vested in something, you're getting your brains beaten in. But if you're not vested in it, you can walk up and say, I'll take that side of the trade. And you know, we were talking about buying houses. If you bought a house for 200 grand, it's a nightmare if it's only worth 100. If you're able to walk up and buy that same house at 90 or 80, it suddenly looks like a good house. I mean, you know, we talk about that in acquiring things. You know, I like almost any asset at the right price. But trouble is price may be zero. You're going to ask a question?
Yeah, to what extent is it reacting to what's happening to you, and to what extent is it you're being proactive and kind of making the right decisions and taking advantage of the opportunities presented to you?
I have made my best decisions when I did things that I wanted to do because they were, I mean, they felt right. It was a personal need. You know, I left, I went back to business school mostly because I liked my job, but I knew I needed more skills. I mean, I was an anthropology major. And then I left the investment bank because it was just cool to go do something different. And I went to Florida for personal reasons, and I left a perfectly good banking job. I mean, you know, actually gave up some income in order to do that, but it felt better to go work for, you know, a young gunslinger than hang around at a bank.
When you guys pro forma deals, how often do those deals match up? Let's say
never. Never. You know they're going to be wrong. Well, remember how? Okay, when you look at that treasury curve, there were some mind-bending swings in there, but they were kind of evened out, and you could draw. I mean, a pro forma. You know, Nathan always likes to say, you know, well, nobody ever pro formas a recession. And actually, when I was working with the Japanese, they used to try to do that. They would run 1,000 scenarios with these new cool things called computers, and they would program in a sine wave function. And they would run it 1,000 times and see what you got. Now, they were running 100-year cash flow analyses, because they were the original hold forever guys. And it was funny because you'd hit the go button, you'd hit enter, and these little number nibblers would start going, and you'd go have dinner, and you'd go check on the thing. You put in a typing pool, which is cool because we didn't have word processing. You literally gave it to a person who typed it for you. And then you'd come back and you would have your answer, but it would give you a bell curve of how things looked. We don't do that, and I'm not sure why. It's just not an investment convention. But Aaron can tell you all about the standard inputs to a Collier Companies investment pro forma. Basically, we grow revenues at about 50 basis points below whatever we trend expenses at, and we have standard inputs for the various pieces of the thing. And it leads to what I'm going to guess is a modestly conservative pro forma. You know, and if our target is 20% and I can get a high teens IRR, I'm pretty confident that I'm probably going to beat it. But I don't know which years I'm going to beat it. Some I will be high, some I will be low. It's good. The other thing about a pro forma is most of the time they're 10 years, and most people don't hold for 10 years. But the only reason I can see that they do that is that you get at the end, you make all these intricate calculations, right? And they spool up, and then you assume at the end of 10 years you sell. Well, that's one ginormous assumption that overrides all the rest. So by putting it 10 years out, through the power of net present value, you de-emphasize your reversion value. And some institutions even put a pie chart showing how much of the return is reversion and how much is cash flow. Anything else? Well, thank you.